Most people believe markets react to headlines. War starts, prices surge, news spreads, charts move. Simple story. But markets rarely move because of what everyone can already see. They move when something beneath the surface begins to shift quietly, long before the headlines catch up. Think about the last few days. Gold moved, silver moved, oil moved sharply, and naturally the explanation circulating everywhere was the same: geopolitical tension, uncertainty, conflict. But here's the uncomfortable truth about financial markets. Bad news by itself doesn't scare markets very much. Traders, institutions, and governments prepare for bad news all the time. What unsettles markets is something else entirely. They fear structural pressure building in the background. Pressure that isn't obvious yet. Pressure that most people aren't measuring. So before we talk about where gold, silver, or oil might go next, we need to slow down for a moment and look at what actually changed over the past several days. Not the narratives, not the speculation, just the observable shifts in price behavior, timing, and market reaction. Because when you step back and examine the facts carefully, the interesting part isn't the volatility itself. It's what the volatility may be revealing about the system underneath. And that's where the real conversation begins. Over the past several trading sessions, several major commodity markets experienced noticeable price movement. Gold and silver both entered the week after rising into the weekend. By early Monday trading, gold briefly moved toward the upper end of its recent trading range before pulling back. At the time of recording, gold has largely remained within a wide range that traders have been observing in recent weeks, roughly between $4,850 and $5,400 per ounce. Silver has followed a similar pattern. Prices have fluctuated within a broad range as well, moving between approximately $71 and $92 per ounce during recent trading activity. While short-term volatility has appeared, the overall range has remained consistent with levels seen in the days leading into the latest geopolitical developments. Oil prices have shown a more pronounced reaction. Compared with levels observed late last week, oil prices have risen by roughly 13%, reflecting a faster adjustment relative to precious metals markets. At the same time, financial news coverage has shifted rapidly. Reports from major media outlets have described changing developments in the ongoing geopolitical situation involving Iran. Some reports suggested rapid changes in military dynamics, while other sources later contradicted those claims. This sequence of reports illustrates how quickly information has been appearing and being reassessed during the past several trading sessions. Market reactions have therefore occurred within a fast-moving information environment where headlines and interpretations have evolved throughout the day. Outside the commodity markets themselves, longer-term fiscal projections continue to attract attention among economists and policy analysts. For example, the Congressional Budget Office, CBO, has published projections suggesting that U.S. federal debt could reach approximately $70 to $73 trillion by 2036 under current fiscal trajectories. These projections are estimates based on existing policy assumptions and do not represent confirmed outcomes. Separately, the CBO has also projected that the U.S. Social Security Trust Fund may face depletion around 2032, which would require policy adjustments if no legislative changes are made beforehand. Again, this is a forecast based on current models rather than a guaranteed result. Taken together, the past week has involved three observable developments: commodity price volatility, rapid news flow around geopolitical events, and continued discussion of long-term fiscal projections from official institutions. Short-term price moves often attract the most attention. A sudden spike in oil or a sharp swing in gold quickly becomes the headline. But in financial markets, the first move is rarely the most important part of the story. What matters more is the chain reaction that follows. Start with the most immediate layer: commodities reacting to uncertainty. When geopolitical tension increases, markets that are closely tied to global supply chains, particularly energy, tend to respond first. Oil is one of the most sensitive commodities in this respect because its price reflects not only current production, but also expectations about future supply stability. A disruption, or even the possibility of disruption, forces traders and institutions to reassess how secure that supply might be in the months ahead. Gold and silver operate somewhat differently. While they can respond to geopolitical developments, they are also influenced by monetary expectations. That means investors often interpret movements in precious metals through the lens of broader financial conditions, interest rates, currency stability, and long-term fiscal outlook. This is where second-order effects begin to appear. For example, fiscal projections published by institutions such as the Congressional Budget Office, CBO, highlight the scale of potential government borrowing over the coming decade. The CBO's projections indicating that U.S. federal debt could approach $70 to $73 trillion by 2036 are not predictions of a crisis. They are forecasts based on current policy assumptions. However, they do illustrate the magnitude of funding that governments may need to manage over time. Large fiscal commitments can influence financial markets through several channels. Governments must either finance spending through taxation, borrowing, or monetary expansion. Each approach affects capital markets differently. Borrowing increases the supply of government debt in financial markets. Monetary expansion, if it occurs, can influence currency valuation and liquidity conditions. These are structural considerations that long-term investors tend to monitor when evaluating assets such as gold or other real assets. Another layer involves energy investment cycles. Developing new oil supply requires significant capital investment and long planning timelines. When prices remain relatively low for extended periods, investment in exploration and development can slow. Over time, this can create tighter supply conditions once demand strengthens again. Analysts in the energy sector have observed this pattern repeatedly across past commodity cycles. In that sense, the recent movements in oil, gold, and silver may represent different parts of a broader system responding to both immediate uncertainty and longer-term structural factors. Oil tends to reflect near-term supply sensitivity. Precious metals tend to reflect expectations about monetary conditions and long-term fiscal dynamics. Understanding this distinction helps separate the headline reaction from the deeper economic mechanisms that may be developing underneath current price movements. If you say "Tiep," I will continue with Section 4, Historical Context, 400 words, where we compare this environment with past market periods without claiming that history will repeat. When markets begin to move quickly, the instinct is to look backward. Investors search for a previous moment that looks similar and then assume the outcome will follow the same path. In practice, history rarely works that way. It provides context, not certainty. There have been several periods where precious metals, energy markets, and fiscal concerns all intersected at the same time. One example often referenced by analysts is the early 2000s. During that period, gold began a sustained upward move after spending nearly 2 decades in a relatively subdued range. Oil prices also started rising after years of underinvestment and lower prices during the late 1990s. At the same time, global monetary conditions were shifting following the burst of the technology bubble and the policy responses that followed. The sequence mattered. Gold did not rise overnight because of a single event. Instead, the move unfolded gradually as investors reassessed monetary conditions, currency stability, and long-term fiscal policies across several major economies. Oil followed its own cycle, responding more directly to global demand growth and supply constraints that had developed during the previous decade. Another useful reference period is the years surrounding the global financial crisis of 2008. During that time, both gold and oil experienced significant volatility. Governments and central banks responded with extraordinary monetary measures designed to stabilize financial systems and restore liquidity to credit markets. However, even in that environment, the drivers were different from today. The 2008 crisis emerged primarily from financial sector instability and the collapse of credit markets. Current discussions among economists tend to focus more on fiscal trajectories, long-term debt sustainability, and structural investment cycles in energy production. This distinction matters. The surface similarities, rising commodity prices, government spending debates, and market volatility can look familiar, but the underlying catalysts may not be identical. History can therefore help investors avoid overreacting to short-term noise. By observing how previous cycles unfolded, it becomes easier to recognize that major market trends usually develop over years rather than days or weeks. At the same time, historical comparisons should be treated carefully. The global economy evolves, financial systems change, and policy responses rarely follow the same script twice. For that reason, history functions best as a reference point, a way to filter emotional reactions, rather than a tool for predicting precise outcomes. Professional investors rarely approach markets with a single prediction. The future rarely unfolds in a straight line, and complex systems like global financial markets respond to many variables at once. Instead of certainty, experienced analysts tend to work with probabilities. Rather than asking what will happen, the more useful question becomes, what conditions would lead to different outcomes? With that in mind, it helps to frame the current environment through three possible scenarios. Supper Warner, bull case, continued strength in commodities. For commodities to continue strengthening, several conditions would likely need to align. First, global liquidity would need to remain supportive. If central banks slow the pace of monetary tightening or begin easing financial conditions in response to economic slowdown, capital often flows toward real assets. Historically, precious metals have responded positively in environments where real interest rates stabilize or decline. Second, fiscal expansion could remain elevated. Projections from institutions such as the Congressional Budget Office, CBO, indicate that government borrowing requirements may remain significant over the coming decade under current policy assumptions. If markets interpret those fiscal trajectories as increasing long-term currency supply or debt issuance, investors sometimes seek assets perceived as stores of value. Third, energy investment cycles may continue to reflect the underinvestment that analysts in the energy sector have discussed in recent years. If capital spending on exploration and development remains constrained while global demand remains steady, supply adjustments can take years to materialize. If those conditions occur together, commodities, particularly gold, silver, and energy assets, could remain supported for an extended period. Base case, stabilization within broad ranges. The most common outcome in financial markets is not extreme movement, but stabilization after periods of volatility. In this scenario, geopolitical tensions gradually stabilize, and supply chains continue functioning without major disruption. Commodity markets would still respond to long-term structural forces such as fiscal policy and investment cycles, but price movements would likely occur within wider ranges rather than through rapid directional trends. Under this path, gold and silver might continue fluctuating as investors balance two opposing forces: expectations of future monetary easing versus the possibility of higher real yields if inflation moderates. Oil markets could similarly move within ranges as global production adjusts gradually and demand growth stabilizes alongside broader economic activity. This type of environment often leads to consolidation periods that can last months or even years, while markets absorb new information. Richard, bear case, structural pressures ease. For commodity strength to reverse more decisively, several different developments would likely need to occur. One possibility would be a sustained strengthening of the US dollar. Commodity prices are typically denominated in dollars, and historically, a stronger dollar has coincided with softer commodity markets. Another factor would be rising real interest rates. If inflation moderates while nominal yields remain elevated, the opportunity cost of holding non-yielding assets such as gold increases, which can reduce investor demand. Energy markets could also soften if global growth slows more sharply than expected, reducing demand for transportation fuels and industrial energy consumption. If these conditions were to emerge together, commodity markets could shift toward a more defensive posture. None of these scenarios represents a certainty. Each depends on evolving economic data, policy decisions, and global market conditions. The purpose of framing markets this way is not to predict a single outcome, but to remain prepared for multiple possibilities. If you say tie up, I will continue with section 6. What I'm watching, 350 words, where we go inside the real indicators professional macro investors track. When markets become noisy, the most useful step is often to narrow the focus. Headlines appear constantly, opinions circulate across social media, and short-term price moves can dominate the conversation. But professional investors typically watch a much smaller set of indicators. The first is the US dollar index, DXY. Because most global commodities are priced in dollars, the direction of the dollar can influence how investors interpret commodity price movements. A strengthening dollar often coincides with tighter global financial conditions, while a weaker dollar can reflect increased liquidity or shifting capital flows. Watching how the dollar behaves during periods of market stress can provide useful context for movements in gold, silver, and energy markets. The second indicator is U.S. Treasury yields, particularly longer-term yields such as the 10-year Treasury. These yields reflect the market's expectations about inflation, economic growth, and the cost of borrowing. Precious metals markets often react to changes in real yields, which combine nominal yields with inflation expectations. Inflation data is another important input. Reports such as the Consumer Price Index, CPI, and the Personal Consumption Expenditures, PCE Index provide insight into how price pressures are evolving across the economy. These indicators influence monetary policy decisions, which in turn affect liquidity conditions across financial markets. Market structure also matters. Professional investors often monitor trading volume, liquidity conditions, and open interest in futures markets. These indicators help reveal whether price movements are being driven by strong participation or by thin trading conditions. Finally, positioning data, such as commitments of traders' reports, can provide insight into how different groups of market participants are currently positioned. When positioning becomes heavily concentrated in one direction, markets sometimes become more sensitive to unexpected shifts. None of these indicators tells the full story on its own, but together they form a framework that helps investors interpret price movements more calmly and with greater context. Financial markets are complex systems. Prices move for many reasons at once, and short-term volatility can sometimes obscure the longer-term forces that are quietly shaping the landscape. Periods like this tend to generate strong opinions and confident predictions. But experience teaches that humility is often the more useful approach. The goal is not to predict every move. It is to understand the environment well enough to manage risk, remain patient, and avoid reacting emotionally to each headline. Markets will continue to adjust as new information appears. Economic data, policy decisions, and global developments. Over time, those signals tend to reveal the underlying direction more clearly. This isn't investment advice. It's simply how I'm reading the market right now. And like every investor, I'll continue watching the data and adjusting as the evidence evolves.